All right, so the purpose of this video is to shed more light to our recent research paper, Understanding Bitcoin's Impact on Portfolio Performance. So we're here with Ben Tsai, who's a managing partner and president of Wave Financial Group. So Ben is a co-author of this research paper. I wanted to probably share more information about it because we received a lot of questions from our investors. So let's just quickly record this video and explain what it is about and go over with a quick overview.
Sure. Yeah. Thank you very much. I'd appreciate the opportunity to talk about the paper a bit. I think I get a lot of questions, and a lot of people get a lot of questions about Bitcoin and pricing and so forth. I come from a more traditional finance background, and therefore I always lean towards using pricing models and having some fundamental discussion with regards to valuation. But Bitcoin is a very difficult thing to wrap our head around that. So I thought it would be great to put a paper out, and that's what we did.
Yeah, so let's maybe start with the executive summary, right? So how different are where are we now in the entire economic environment, compared to the let's say a few years ago, and comparing to your traditional portfolio and the correlation to other asset classes, and why there is such a huge demand, generally from institutions to add Bitcoin in their diversified portfolio?
Sure, I'll take that on a very macro basis. Investments has always been about looking at all the available opportunities and what to invest in. The world of investing really started with fixed income and then subsequently equity, and that being the main investment instruments for a lot of people. Then came, real estate, which used to be a part less about investments, and it became more about an investment tool. And with the advent of REITs, that became more popular as part of the portfolio to have exposure to real estate. We then had a commodities boom where there were a lot of ETFs introduced on the commodity side. So involvement there, and then subsequent to that, really private equity, hedge funds, and so forth. And that led to the idea of alternative investments. A lot of the endowment funds and so forth have decided to go down that path to capture higher returns in less liquid markets, or more advanced markets, or more alternative markets, to try to generate more yield for their investors when they can take much longer term risk. And from that idea came with a move away from a very traditional 60-40 equity fixed income portfolio and moving more towards a balanced portfolio. That thought really drives the whole endowment investment thesis. And over long periods of time, the investments have done very well. And because of that, a lot of investors are adopting to that investment style of adding alternatives to their portfolio.
Yeah, and so recently there were predictions, by such reputable firms as Guggenheim Partners that Bitcoin is going to hit like $400,000 by 2024, 25. And then they look at this as a new asset class that is must have at least 1% of your assets in Bitcoin. So why is that? What happened with this narrative of digital gold?
Sure. I think, 1%, whether that number is correct or not, really depends on the person. I tend to get asked that question, how much of my portfolio should be in Bitcoin? And I typically do not want to give an answer. I think it's a different answer for everybody. The volatility of Bitcoin and cryptocurrencies in general are quite high, and therefore they may or may not be suitable for everybody in terms of the amount of volatility or amount of risk that clients are willing to stomach. Also, depending on the timing of the portfolio, that may or may not be the right investment. With that said, compared to most of the traditional assets, Bitcoin has been the best performing asset class in a 1 year, 3 year, 5 year, and 10-year time frame. So from that perspective, some inclusion of that from a return perspective would be very good, and we can visit that later on in this conversation.
So let's jump probably in the in the research paper, right? So the
Sure.
performance, since in the past 10 years, it's been, as you've mentioned, great. It's the most the most profitable, the most exciting, for many people, asset class in the past decade, right? And how, and we see a lot of billionaires, big institutions, now invested in openly, talks have been going on in CNBC, Bloomberg every day. A lot of products, like ETFs, like some other derivatives are being designed. And so how do you value Bitcoin? Maybe let's start from this.
Sure. I have showing on the shared screen the performance of BTC over the past a few months. Basically, this is from October 2020 all the way to 2021. The return has been amazing. The last quarter, or the last 2 quarters, have seen a significant increase in Bitcoin prices reaching all-time highs over 60,000. So from that perspective, it's an increasing asset class that's come really into focus. This has led to the question of what should we use as a pricing model and how does that make sense? Mm-hmm. I think before I jump into that, I wrote a little bit about different things that use different pricing models. So it wouldn't really be fair for us to take a single pricing model and apply it to all the assets. And this is true even in the equities world. If you're looking at, seed level or angel level investments, it's really about the idea, the founders, their addressable market, what they're going after. Whereas you go into a Series D or public markets, is more about growth. And then at some point, it's about maximizing your returns. And at a very late stage in the business cycle, sometimes the valuation is actually on what they call PBR, price to book value. And it's really, if you went and sold the assets in the firm, assuming no growth, assuming nothing, you sold the assets, how much is that company worth? It's a little bit depressing to think about kind of a liquidation value, but those are very different ways of looking at a company. It would not be fair for you to apply a growth model to, for example, a utility. Utility really doesn't have much growth. You're not going to look at that as a revenue model doing DCF and so forth. Just like you would never do, a price to book ratio on a startup. What assets does a startup have? The idea is not, you can't put a value on the idea, and the assets they own is a lot of times nothing, someone's garage or something. So for what it's worth, we look at different pricing models, and we're looking at how to value this. For Bitcoin has gone through a few phases of valuation from my perspective. At the very beginning of this, when it first started as a trinket, as a reward for running a software system on your computer as part of a global network, Bitcoin, basically, when you run a node, you're solving mathematical puzzles, and whoever solves a mathematical puzzle gets a reward, and that is Bitcoin. So that is something that, initially wasn't worth very much because there were not a lot of participants in the network, and there was not a lot of recognition of that being of a lot of value. And then we went into the phase, and during that phase, somebody actually, as an example in our chart, somebody went and bought 2 pizzas for 10,000 Bitcoins. Right now, each Bitcoin is $60,000, and they spent 10,000 Bitcoins for 2 pizzas. It's a very expensive pizza. So, at 40,000, I think it's $400 million for the 2 pizzas, and at 60,000, $600 million. So it's $300 million per pizza if the person had kept it. It's not a fair comparison, but it's just a funny anecdotal thing that most people in crypto know.
Yeah, I hope they like this pizza. There's an interview with this guy who actually bought it. He was pretty depressed for a few years, and we can understand why.
Yeah, and for to be fair, this goes back to the valuation model. When you're hungry, you can't eat Bitcoin. So who's to say that was not the right trade at that time? So
yeah. But coming back from more institutional adoption, when the CIO of BlackRock is saying that digital assets are there to stay, and he's not endorsing directly Bitcoin, but he's saying that there's a potential of Bitcoin to replace gold to a large extent. So we're writing a little bit about how would you explain in comparison to gold, where is Bitcoin?
Sure. Yeah. Let me kind of continue my story of the varying different models of valuing it. At first, as an electronics trinket, it isn't of much value. I think it then went through a phase of, oh, this is great. It's a unique asset. It's non-fungible. It's great. Well, let's use this as money. So maybe we use it as a settlement system. So, why don't you, go to the coffee shop and buy coffee with Bitcoin? That was the next idea. And that's part of, the whole pizza example, is that Yes, you could do it that way. It doesn't make a lot of sense. The system itself is actually not that efficient. It takes about 15-20 minutes for a first confirmation to come through. Typically, people wait for 4 to 6 confirmations before they're comfortable with the transaction. It does take a little bit of time. If you were trying to pay with Bitcoin over a cup of coffee, the coffee would be cold by the time the transaction's confirmed. So from that perspective, it doesn't make as much sense. So the value is not so high. From that point, we moved into the next valuation or the next way of thinking of Bitcoin. What if we thought of Bitcoin as a store of value? It is a block of gold. It is a piece of something that we are comfortable trading with each other, that we both agree that has some intrinsic value to it. This gets into, the mind of a lot of analysis that finance people have difficulties getting over with, and me included when I first started this. What is the value of gold? Well, the value is notable in terms of gold. And then, taking a look at, value of the dollar. Well, what is the value of a dollar? It's actually just money printed on a piece of paper. It's valuable because both parties have agreed to trade on it. Just like gold is an instrument that both sides have agreed to trade on it. There's a market, you can go and liquidate it and generate economic value. You can then buy something to eat and so forth. So it's linked to reality from that perspective. And at that point, I think people are willing to consider Bitcoin as a store of value similar to gold. Then it goes to, well, how is gold valued? And that leads us to the valuation model for Bitcoin, which we have, one of the models that we're discussing in this paper is to use a gold valuation model to model Bitcoin, which we believe has been quite good.
Mm-hmm. I think it's on this next page, right? So we're talking about the like the cost of storage, the speed of movement, the supply schedule, the control and the volatility, right? And because of this deflationary economy that Bitcoin blockchain by design has only 21 million Bitcoin, it can never be issued more, right? And so there is a unique, scarcity element to it, right? And that also adds up to the value, right? And then the supply demand metrics, they kind of help, to mitigate the Bitcoin monetary inflation. So let's maybe explain a little bit, how this works.
Sure. I think you've covered actually most of the points. The discussion, and that's totally fine. I think it's a good summary of it. When we compare to Bitcoin to gold, it compares very favorably. Cost of storage is very cheap. You can put $1 billion on a Trezor. It doesn't take up a lot of space as opposed to gold, where the physical aspect of it is very expensive. On top of that, for security reasons, you would then have to guard the vault, you guard Fort Knox, you guard places where you store gold. And that's just for storage. If you had to move it, that's also very difficult. We can move $1 billion worth of Bitcoin from one end of the globe to the other relatively quickly, 16 minutes of first confirmation and so forth. Whereas if you had to transport $1 billion worth of gold, it's multiple flights, it's armies of security around that. The beginning location, ending location, making sure that there's secrecy so people don't come rob you for $1 billion worth of gold. You can imagine the logistics nightmare around all of that. Obviously, the cost would be very expensive also to ship $1 billion worth of gold from one end to the other. Just the logistics cost would be crazy. So from that perspective, these are very good. One interesting point, which we'll get into in a little more detail, is supply schedule. Gold is being mined right now out of the earth. In theory, there's a limited amount of gold on this planet, short of us chemically creating gold, which is very expensive. It's not worth the discussion. There is a limited supply. So as we mine, the supplies go down at some point. We also look at the mining speed. The mining speed is actually not constant. The mining speed moves up when the gold price goes up and moves down when the price goes down, and therefore stabilizes the price of gold from that supply and demand perspective. Bitcoin, interestingly enough, has a fixed supply schedule. I say fixed as in the schedule is set. I'm not saying that it's a constant schedule. Every 4 years, actually, the value of the amount of Bitcoin that comes out per block is lower. So on the blockchain, basically, you're running these calculations, and it's designed so that the solution comes out roughly about 10 minutes for every solution. At every block that comes out every 10 minutes, the system spits out 50 Bitcoins in 2009 when the system started. In between 2012, 2016, it was halved. And that's how the system works. Every 4 years, the value is halved. So we went from 50 to 25 to 12 and a half. We're currently at 6.25. That started in May of 2020, and we will go to roughly May of 2024 before we go down to the next halving. The 6.25 will go to 3 1/8. I think there's a typo in our report, actually. Basically, it'll halve. So you know exactly what the supply schedule is of Bitcoin coming out. And we've actually plotted this in terms of the amount of Bitcoin that comes in existence. And as the design goes, it's designed to never surpass 21 million. And, there's some rounding errors there. It's 21 million in a tiny bit, but basically 21 million, the supply flattens out. So there is no more Bitcoin to be mined. Similar to gold, there will be at some point no more gold to be mined. So from that perspective, we have a lot more clarity in terms of supply, and therefore we should be able to better value it. And finally, in terms of control, Bitcoin is decentralized, where gold production and sales and so forth have various regulations attached to them, and they're actually country specific. So from that perspective, Bitcoin actually has a bit more clarity in terms of being able to be used. And the final point people compare and people are a little more negative with regards to Bitcoin is with regards to volatility. The volatility of price is very high. From my perspective, that has to do with the fact that people are still trying to grasp the value of Bitcoin. Bitcoin's been around only since 2009, so only really less than 12 years, whereas gold has been around for a very, very, very long time. The price discovery process, the random people that want to buy and sell that significantly drive value in either direction are really gone. People who really want tons and tons of gold immediately are gone. The people that really want it already bought it, and the people that sold it already sold it. So it's all incremental exchanges, and therefore the prices are very stable. So, that addresses the volatility point. And, I can get into more details with regards to the actual pricing model next, if that's of interest.
Yeah, sure. I think the pricing model is really interesting narrative because, there are a lot of big investors around us, also comparing gold narrative to almost like a belief system, because we never go to Fort Knox. We actually don't trade gold as well, right? So people, and there's a famous debate of Peter Schiff with Eric Voorhees, and but on the practical side, one of our investors actually asked a very interesting question. He said, reading the report, he asked, listen, is it a fair assumption that with the price right now of with a range of 50,000 to 60,000 depending on the day, right? And the market cap of 1 trillion, and we're showing here that the gold is roughly $8.5 trillion market value. So is it, or some people say that it's 9 or 10? Is it fair to assume that it might actually almost 10x from now, when the market cap of Bitcoin will equalize with gold?
Sure. I think, so in comparison to gold, I think we would start the story with, well, how do you value gold? So I used to run commodities for Bank of America Merrill Lynch across Asia. So it's very interesting to me. We had a desk that traded gold, precious metals, base metals, energy and so forth. So we face this question all the time. Although it was an internal transfer, they actually interviewed me. And one of the interview questions was, how do you value gold? And my answer to them, fundamentally, there's no value to gold. The actual industrial applications of gold are extremely limited. Jewelry probably is a large component of that. And that's really it. Apparently that's the right answer, as I became the head of commodities for Merrill Lynch. So I guess that was the right answer. But, that's a funny story aside. It really is about, how people are valuing gold. And the model that is typically used is what's called the stock to flow model. And there are other models to gold. So I don't want to make it sound like this is the only model, but this is one of the commonly accepted model to gold. And the stock to flow model is just really a comparison of what is in stock, which is in reserve, versus what is being produced on an annual basis. So they're using an annual number divided by, or the stock divided by the annual production number.
I guess next page, right?
Yeah. So, for example, it's actually on the page I'm displaying right now. For example, gold right now has a stock to flow of roughly 62. Depending on where you read, it's between 62 to 65 because the flow, changes depending on who your estimates are. But basically, the stock is pretty set. There's no major industrial application, so the reserve of gold doesn't actually go down. Most people are holding it as store of value, and the flow that comes out every single day or every single year is actually a very small number compared to the stock. So you get a stock overflow number of 62. Some people debate at 65, but it's somewhere in the 60s, mid 60s number as a stock to flow number. We then look at some of the other metals, the precious metals, silver at 22, palladium 1.1, platinum 0.4. And if you look at also on more of the base metal, the reason we call them base metal is for things like copper and aluminum and so forth, that number is even lower. The people don't store an extreme amounts, like years and years of gold, aluminum or copper, because they just store enough so they can have enough for usage. So the concept is really usage and not storing for value. And therefore, those metals have a very low stock to flow. So with gold at 62, that gives it the market valuation of $8 to $9 billion, very roughly. If we took, let me just take a quick look at what I have on the next slide here. So if you took the Bitcoin supply and you divide that by the annual production rate, and as we had discussed this before, that number actually drops every 4 years. If we just took today's number, the number that came into play in May of 2020, we get a ratio of roughly about 50 to 1. So 50 to 1 is actually getting close to gold, and our valuation for Bitcoin is nowhere near gold. So at the same time, we worked on some of this analysis, or we looked at some of this analysis actually from a person named Plan B that published this information on Medium. So that analysis we thought was very complete, and that was something that we've been talking about, we've been looking at. We really like the analysis in the sense that the fit on the model is very, very good, both for gold and also for Bitcoin over time. The analysis actually looked into comparing it at the last halving, which is a year ago at the last production rate, and also previous production rates. And as you can see, all the dots actually fit quite well on that line. So from that perspective, we're very comfortable with the model. That research that we read actually came out in 2019. So this wasn't that new a research. And at that time, there was a prediction of, at the current halving, where we're at the ratio of 50, the target rate or the fit on that curve would tell us that Bitcoin should be worth roughly $55,000. And at that time, people said, wow, that's a very aggressive number. I think at that time, Bitcoin was below 10,000. It was somewhere in the ballpark of 8,000. This guy comes out and says 2 years later, when the halving happens, it'll take a few months to stabilize. Once it's stabilized, it's worth, 55,000. And people said, that's crazy talk. That's so far away. And right now, we're about, 6 months, 8 months into the halving, a little more than that, 8 months into the halving. And we're currently over 55,000. So it has actually, the fit continues to be very good with this current discussion, with the current analysis. So of course, as people that read this paper don't want to know what happened historically. This is not a history lesson. The next question is, well, what happens next? What does this model tell us?
Next halving,
yeah, exactly. At the next halving, what happens? The next halving is somewhere in the ballpark of May of 2024. And that's 3 years and change away. And at that next halving, as opposed to the current stock to flow of 50, we would get up to a stock to flow of close to 100 because the flow would have, and the stock is not increasing that much. And from that perspective, we're looking at probably a ratio of 90 or so, and that would be greater than gold. According to this model, it would mean that Bitcoin would be worth more than gold simply from a stock to flow discussion. So the market cap would exceed that 9 billion. And to be more exact on this model fit, it would point to a $400,000 per Bitcoin price.
So you mean 9 trillion, right?
So somewhere, yeah, that's correct. Sorry, okay. 9 trillion. Yeah, not 9 billion. Yeah, sorry. A few zeros.
No, it's fine. So who counts, So then the other narrative is like also the institutions who are like buying and holding Bitcoin, and they are treating it as a reserve like asset, right? And we've just showed a little bit here. Maybe we can skip it for people who want to read deeper into the names, but we can jump immediately to the narrative of the publicly traded companies who actually put Bitcoin on their balance sheet. So maybe you can comment a little bit on this, like why would a publicly traded company like, MicroStrategy, Square, now Tesla, and we hear some rumors that Oracle is soon going to join this game. So why would they do that?
So I think there are a number of discussions that we're blowing through, and I'll just mention a few of these along with addressing your question of the corporate adoption. I think the corporate adoption is not on the leading end of it. The actual leading end, or the bleeding end, as people would call it, is a lot of the pioneers in this market, both on the from the startup side who have become mainstream, like Coinbase and so forth, and also for a lot of the traditional players who have been working very hard in the background to build the infrastructure, like the Fidelities of the world and so forth. And I'm sure I should be naming 10 other firms, but just as examples, I'll stop at those two. They're really building an infrastructure that we can get comfortable with. Fidelity, the first thing they launched officially was a custodial service. It is something that is necessary before people can get comfortable with investing, that the infrastructure is in place. On the exchange side, obviously, Coinbase has provided a great platform for exchange. And there are other exchanges. Once again, I'm not saying it's just Coinbase, but a lot of these pioneers are really building more institutional grade solutions so people can get comfortable taking exposures into these asset classes. I would say that would be the first step. The second step is the institutional investors who are a lot more aggressive. And sometimes that's like hedge funds, which typically people think of when they think of aggressive investors. But there are also high net worth clients who have decided to dedicate, a few percent of their wealth to this. And there have been actually a lot of what we call crypto whales who have built their wealth from this increase in value in crypto. And, I commend them for their explorer spirits to go out and be able to do this, because they took a risk and they're rewarded for that risk. And it was a much higher risk than those people coming in today. And it'll be a higher risk than people will be coming in the future. But they're also paving the way, and that is basically the foundation of where we're at. And from that point, I think some of the major guys who have stepped up and started saying different things that are really driving this. Stanley Druckenmiller, a big traditional investor, came in and said, "This is great. Would compare to gold, this makes sense. Let's do that." So that's one. And we've had a few other big hedge fund managers. Paul Tudor Jones came out, and I think he was one of the leaders in this space and mentioned that he's going to put in his fund, and he thought that was a great thing. And then we had a resurgence of, not a resurgence, but a surge of publicly listed companies who are looking at this, like Michael Saylor and so forth. Michael Saylor, MicroStrategy, probably as a percentage of treasury, which basically is 100% of treasury, if not more. They've borrowed money to beef this up. They've gone completely into crypto because they believe in it. And they piled in a crypto before it went to 50,000. They piled in, I think, at 18,000, I think their average price. And I haven't counted their recent purchases, but they really kind of bought in before the big rally in the past quarter. And therefore, they're really benefiting from that right now. And his thought is really more on holding fiat is potentially a risk, because by inflation, that may not be good enough anymore. All the governments around the world are printing a lot of money. And last year, a lot of people piled into gold, a lot of people piled into Bitcoin. It's really about having hard assets, have something that does not devalue as more dollars are printed out. Right now, I think there's a fundamental debate on, as you mentioned, we don't go to Fort Knox to check on the gold. But, when you hand somebody a dollar or someone hands you a dollar, you're not going to check the value of the dollar. But there is an issue because those dollars are getting printed every day, a lot of dollars and being distributed. Yeah, they're still good, but they're good for how much? I think that value may be decreasing, and therefore holding hard assets make a lot of sense. And I think that's the direction Michael Saylor thinks about in a relatively extreme way, in the sense that he's dedicated his whole treasury into it. Tesla's announced they're buying $1.5 billion. PayPal is in, a few other companies are in. They are buying a small portion just as hedge to make sure that they have that exposure, that it's proper. This is somewhat similar to having a foreign exchange exposure if you are trading internationally with other companies internationally and you're exposed to their currency risk. If you're getting income in another stream, you want to have that hedge. And from Michael Saylor's perspective, he wants to be hedged against the loss of value in dollars, and he's hedging by buying Bitcoin. in a very extreme way.
Yeah.
So yeah.
It's 70 as of the day of this recording. It's actually, I've just looked it up. Well, 71% of MicroStrategy's treasury is in Bitcoin, and yeah, this is a pretty big number. And at the same time, like on the flip side, like we analyze it on the critical side, but also like if we look at the year to date of MicroStrategy as a stock, I mean it did a tremendous flip-flop, like it's quadrupled. So yeah, so there is like pros and cons to that, and I think it's a beautiful comparison to foreign exchange, like hedge against the inflation that you provided. So from this, maybe we can go to the kind of next level of narrative that we can present, and that's just like how is it correlated to other asset classes, and what do we get when we actually like add up Bitcoin to the portfolio, right? And maybe before that, you can speak a little bit about the public debt and what's the budget deficit and where we are in the economy right now.
Sure. Yeah, I don't want to get into this too much because I think most people can get their news and they've had this multiple conversations here. The U.S. and globally, a lot of the governments are printing a lot of debt and creating a lot of currency and priming the pump, as they say. They're just pouring that currency into the economy, hoping that it'll generate inflation and keep businesses going. I think it's a noble thought. I think to a certain extent it is necessary. But at the end of the day, as an investor, that is a risk for the value of the portfolio from an inflationary perspective. It's great I'm earning, a few percent of my dollars, but if the price of my consumption increases more than a few dollars, then I have issues with continuing to keep up my lifestyle and so forth. So that is basically a risk with inflation. So I'm sure everybody on the call understands that. I'm going to set that aside. I think the next discussion, actually, we're switching over from the theory and the why and the background and the pricing model and the idea to, well, okay, let's assume that that's a viable model. Let's assume we believe stock to flow. Let's assume that we're okay with this. What does that mean for investment from an investment perspective? How do we use this asset class as part of our portfolio? And that was the second half of this report that we really wanted to address. So I'll just jump right in. As everybody understands, as you have assets with different correlation, if you add them together, you're going to be able to reduce risk while improving your return profile. So we have an asset class that is that has returned quite well. On page 16 on the right-hand side, my right-hand side, what you can see is a significant increase in value, over the time span from 2013 to 2021. And that increase is actually very, very significant. And even though the increase doesn't seem a lot in 2013 to 2016, there's actually a pretty large increase. It's just that the subsequent increases are so big that the first part of increase, you don't see it as much. It doesn't get magnified. But there are huge increases throughout this time frame. And I think a lot of people are actually saying that you should use a log graph to see this because the scale is so big. And it's been a really good returning asset class. And if you take a look at if you look at that, it makes a lot of sense. So, on to kind of a correlation discussion. I don't want to bore people with traditional finance concepts, which I'm sure most people are familiar with. What you want to do is you want to have a basket of diversified assets. So you're always making money with something. And over the long term, that gives you a more balanced exposure that will maximize return over time. You can also increase and decrease your exposure to that basket and balance it with cash. And by that, or whatever cash you're using as benchmark, by doing that, you can increase and decreasing your risk levels to the right risk return profile. In theory, maximizing your return from a financial modeling perspective. So first things first, correlation of Bitcoin is extremely low to other asset classes, and that is a beautiful thing. For all the alternative investments that get adopted, it's always an interest in finding an asset class that has low correlation with the existing asset classes. There's a risk of piling everything into the same asset class or the correlated asset class where a crash in the market really reduces the return profile of your total portfolio because for example, you bought three assets that are, let's say you buy three car makers, and they all move poorly when car sales are down, then you're taking more risk from that perspective by not being diversified. So we take a quick look. Bitcoin is actually 17% correlated with gold, 2% correlated with S&P, 3% correlated with NASDAQ, -5% with MSCI, and so forth. And this is a very interesting thing. It's mostly single digits. You've got gold at in the teens, and US dollar 10-year treasury rates in the teens. Those are extremely low numbers, and that is a great thing. And you want to get as close to zero as possible. Plus 100 doesn't work, minus 100 doesn't work either. So having decorrelated assets is the most optimal. So with that in mind, we looked at taking a basket, or we looked at investing, for example, in the S&P. Having an S&P portfolio with no Bitcoin generates the gray line on the right-hand side. It's the line at the very bottom. By adding 1% Bitcoin, we're increasing the return profile significantly. By adding 5%, we're increasing even more. By adding 10%, we're increasing even more. At the same time, we're increasing the volatility of the portfolio. We're increasing the risk for the client. So we're getting more risk. Are we getting more return on an absolute basis? Yes. Are we getting a more return on a relative basis to the risk? That is the question that proper financial analysis should be covering. So what we've decided to look at is the Sharpe ratio and the Sortino ratio. The Sharpe ratio accounts for the amount of extra standard deviation, extra volatility, extra risk associated with holding that portfolio. Mm-hmm. And what we're seeing is that by increasing the Bitcoin weights, your Sharpe ratio is going up, which means that you're improving the portfolio. If you keep adding Bitcoin, at some point, the Sharpe ratio starts to come off. And that is when you hit that optimal point from a risk return perspective, and it fades out. At the same time, we looked at a Sortino ratio. The Sortino ratio is actually just a Sharpe ratio, except we are only looking at volatility on the upside as opposed to the downside. Volatility on the downside, not the upside. And the reason for that is people don't mind taking volatility when it's heading upward. They only care when they're taking volatility risk on the downside, which kind of makes sense. So the Sortino ratio is great. And as you can see in this, the Sortino ratio actually increases significantly with Bitcoin. And part of that is telling you that the Sharpe ratio is only increasing a little bit because it's volatile on the upside also. But the Sortino ratio is telling you that extra risk you're picking up, it's high quality risk. It means that you're extra pointing more up than down, which is a great thing to have. So those are ways that you look at some of these benchmarks, and that is why we're recommending that this be done.
Got it. So in other words, for now, like can we say that Bitcoin is almost like a must-have, like in the reasonable portfolio, like diversified portfolio, according to modern portfolio theory, or according to other metrics that we can apply?
My simple answer is yes, but I want to caveat that a little bit. As you can tell, with zero Bitcoin in this portfolio, the volatility is 15% on an absolute basis, regardless of the Sharpe ratio and the Sortino ratio discussion. If you add 1%, it jumps up to 18. With 5%, it goes to 35. With 10%, it goes up to 47. So if you have a target volatility of 20% or 30%, you can maybe add 1 or 2%, maybe 3% of Bitcoin. But if your target volatility is below 20%, you would not really be able to add Bitcoin. So there is an absolute ceiling of risk that you're willing to take and whether that should be included. And I would say a 20% volatility cap would be relatively conservative. And even then you can still add 1%. So I would say for most people, having some Bitcoin in their portfolio is probably the right thing to do.
And it's ironic because in 2020, Bloomberg reported that Bitcoin volatility is lower than a lot of the S&P 500 stocks, right? And so we've been in a situation where it was lower, and I mean, it changes obviously, and we're taking the average volatility, but in time, there are a lot of experts and researchers, they say that it will stabilize, right? So therefore, there will be even more improvements in the Sharpe and Sortino ratio, right?
That's correct. It's kind of an interesting thing. The volatility is up because Bitcoin has increased so much in value. It's the upside volatility that we're trying to say, it's funny. People say volatility equals risk. And actually, to be blunt, only downside volatility is equal to risk. Nobody ever complained when it went up too much, right? So, from that perspective, it's something to be very careful about. A lot of that volatility comes from it rising too much, and therefore you're having a big variation in price, big standard deviation. But certainly, I don't think any holders of Bitcoin are complaining that it's going up too much.
For sure. Yeah, I'm sure they don't. So maybe you can also say a few words, like about the 60/40 portfolio. That is considered a traditional stocks and bonds portfolio. And how would, like a little increment, like if we add, let's say 1% or 5% of Bitcoin, how will it improve it? And maybe like from the practical standpoint of view, like, so what we can conclude from that, and like how would an institutional investor like should act with their portfolio, and how the more retail investors should treat their portfolio.
Sure. I think what we did is in the paper was we moved, we increased the level of complexity with our analysis. We started with just an S&P equity portfolio. Most people don't just hold an S&P equity portfolio. So we thought we would go to the next analysis. The next analysis as a benchmark would be a 60/40 portfolio, equity 60%, fixed income 40%. And we basically plotted that out. On the chart on the left, you could see it's a rising market, but relatively flat in the grand scheme of things for the lower line, which is a 60/40 portfolio. We add, just for simplicity, we just said, let's add 5% allocation of Bitcoin. And what that does is that increases return profile significantly, as you can see here. It did also increase the volatility. So I want to be very clear that this is a higher volatility product. But from a Sharpe ratio perspective, we just went from 0.7 to 1.05, which is a significant improvement. On a Sortino ratio basis, we've actually doubled in Sortino ratio, and therefore it really is the right thing to do. It's a positive thing. And on an absolute return basis, we've added roughly another 380% into a from 2016 to 2020, which is the time frame we're looking at right now. So that is very interesting. So we took it one step further. If you think about it, people don't just hold stocks and bonds. I don't think anybody does a 60/40 portfolio anymore. People hold more diversified portfolios. So what we've done is we've put a portfolio together where we have S&P 500, NASDAQ 100, MSCI emerging markets, which with 16.6% each on those weights. We also took 30% in fixed income, and we did 10% in crude oil and 10% in gold, just a complete diversified portfolio. That is a portfolio that people may hold. Somebody may hold roughly this portfolio. It sounds a bit institutional. And, if you are a corporate guy running your institutional portfolio, this could be, what you're looking at. From there, what you're seeing is that Sharpe ratio is actually 0.88 just for the diversified portfolio, which, makes sense. And if we add 5% of BTC into it and just dropping the rest of the ratios proportionately, we're seeing the Sharpe ratio go up to 1.09. Sortino ratio, once again, increased significantly. And, all in all, it's once again a significant improvement in the return profile. If you just even look at it without Bitcoin, you can tell the diversified portfolio does better than the traditional portfolio. But just putting the Bitcoin in at 5% changes the complexion of the investment significantly. So, from that perspective, we really believe that there's an improvement in performance and, improvement in Sharpe ratio, a big improvement in Sortino ratio, which is actually the best benchmark to use for our conversation. And really, people should consider having a percentage of some sort into their portfolio.
Yeah, and I think that is the conclusion of the research paper, right? So that the diversified portfolio in the modern portfolio theory, in our opinion as well, it's just like Bitcoin is the must-have asset, and we're running several funds in it. Again, not an investment advice to invest directly in our funds, but we're welcome to have a conversation, obviously, with people who are interested and. You can also download this research paper if you haven't done so on our website, wavegp.com/research. We also have a Ethereum 2.0 research paper. So Potentially, we're going to do another video about that. But for today, I think Ben, you did a tremendous job explaining, like what we're trying to convey in this particular research paper. And I think, yeah, we just welcome any other questions in the comments or just write us directly.
Yep. Thank you very much for your time today. Look forward to hearing more from everyone with regards to investments in Bitcoin.
Thank you.